Hello all, welcome to www.bispsolutions.com. In this series of webinar sessions where we are telling you how to use Excel for various financial planning, today we're going to see financial modeling and sensitivity modeling. So we'll start with the conceptual understanding of the financial modeling, why it is required, what is the necessity of doing financial modeling as well as sensitivity modeling. There would be Excel techniques for the both the modeling methods, and hereby will tell you the best practices. So to explain this, let me tell you one of the examples so that the concept behind financial modeling as well as sensitivity modeling becomes little clear. So let's suppose Emma, who sells handmade scented candles. The product the scented candles, handmade candles that Emma sells. Now she has a small startup known as Glow Candles where she is doing this business. From home only she is operating the business. It could be offline, it could be online, any ways. The Okay, so I was telling you the example here, one of the stories which you can relate with the topic that I'm going to take today. We have a vendor over here who is Emma, and she's making a scented candles and having a small startup of uh, uh, these handmade candles. Now she wants to rent a small workshop. Let's say for she plans to rent a small workshop, let's say for $1,000. This is the future planning she is assuming. She also want to invest in certain packagings to improve the quality and look of the product. So these are the future assumptions that uh, these are the future plans, these are the forecasted plans, but she is doubtful because she doesn't know how she goes about it, what should be the costing, what should be the revenue to earn, the net profit to earn, so that she can afford all these expenses in future. So she'll begin with calculating her cost. Let's suppose the cost of raw material over here for wax, fragrances, per candle. We'll assuming the we are clubbing up the entire raw material. Let's suppose it is $5. Also there are certain packaging and shipping cost, you can say delivery cost. Let's assume this to be $10. Right now her revenue, you can say the sale which she is doing per month, is almost for 200 products. So according to this, her calculation for cost would come to be revenue. This would be, right now the sale is, I've told you, this is almost 200 of the now product, and here per candle would the price per candle, the cost, you can say, the price, let's suppose, is 20. So revenue, simple as it is, this would be 200 into $20, that makes and let's calculate the cost, variable cost over here. Raw material is $5 right now, packaging shipping is 10, so almost this cost about 15. So this is $3,000. This way I get the profit figure over here, 4,000 minus 3,000, that is $1,000. Simple as it is. Now if you see, she has future plans to rent a small workshop. The rent would be 1,000 per month. There she is also planning to invest into packaging so that her sale would increase, but right now the profit is just 1,000, so she is barely making a profit to afford the future expenses. So this is a simple calculation which we have done. We have got only few figures to calculate the future estimated cost, to so that right now on the basis of the actual data we are calculating the profit. Now how much she should increase the revenue, or how much she should increase the sale of per product, or maybe how much she should increase the per unit price, so that she could earn profit that could give the expenses to meet the future obligations or future forecast. This is what we do in the financial modeling. So basically, financial modeling is used to forecast a company's financial performance, which is based on historical data, key assumptions, and financial drivers. It helps businesses to make informed decisions related to pricing strategy, like assessing how different price points would impact revenue and profit. Then it would help in investment decisions, that is evaluating the new projects, acquisitions, or funding requirements. It will also help in budgeting and forecasting by predicting future cash flows, expenses, and profitability. Then scenario and sensitivity analysis, where it is also done in financial modeling, where we understand financial risk by testing the different assumptions. Next we have sensitivity analysis, which is a technique used to analyze how changes in key variables, that is price or demand or cost, would impact the financial outcomes. Like here in the example that we just took here, how would the price, changing in the price or changing in the unit sold, or maybe changing in the variable cost, how will this impact the profit in the future, so that we can assess the risk and opportunities by testing different assumptions. So here this is one extract here by which we do sensitivity modeling. Just if you can see here, there what is the impact on the share price by change in the assumptions. If you see, the discount rate, if it is plus or minus 1, then the impact would be between -5 to 5%. So this way, if there would be changes in the variable prices or cost, or in the uh, other rates, expenses, you can see how the revenue growth is there. This is simple extract, one of the examples where by which we do sensitivity modeling. Okay, so let's start the financial and sensitivity modeling. Here you will see I have already created a small income statement. To make the case simple, we are taking very few heads in the income statement. Continuing with our example with the last session, where we had created the 3 financial statements. We have created it from the scratch, the basic uh, uh, statements in Excel. We have taken a mid-size IT firm. The same example we continue today. So this is the Technowave IT firm, and this has the revenue over here. I'll put the revenue. First you see the assumptions. We have taken the assumptions. Right now the current price per subscription, okay, this is $50, and we have the customer base of 10,000. The variable cost per customers comes to be $30. These are all calculated figures that we have already done yesterday by making the income statement as well as balance sheet and the cash flows. So here we are projecting, we are doing the financial modeling. So on the basis of these assumptions, which are based on historical data as well as on market trend, we have acquired these assumptions, we have made these assumptions, and on these assumptions we are going to calculate the forecasted income statement, as well as we are going to see how can we use financial and sensitivity modeling to forecast the future opportunities, or if there is any emergency required, or if there is any short of funds, or if the business performance is not up to date. All this can be checked with the help of sensitivity modeling and financial modeling. For this we need to have certain assumptions on the basis of maybe the market trends, or forecast the historical data. So right now we have the customer base of 10,000 we are assuming, and current price subscription we are charging $50. We have fixed cost, which includes the salaries, infrastructure, marketing cost. This is 1 lakh. And taxes, all these fixed cost and taxes, both of these are fixed in nature. So taxes, that is fixed, 10% on the net income. Now on the basis of this, I'll create the income statement. Revenue would be customer base multiplied with the current price. Then we have cost of goods sold over here. So here I have taken all the variable cost which is there. I have totaled it up, and it is $30. And this I'm making it as negative, because here we have put the formula of sum. So since this is totaling up, I have made all the expenses coming here, like cost of goods sold, fixed assets, fixed cost, and taxes. I will keep it as negative. Now fixed cost, this is similar to the one, there would not be any changes. This is fixed. So we have got here the gross profit, which is the difference of revenue and cost of goods sold. When we deduct fixed costs from the gross profit, we get earning before taxes. Now see, taxes will only be charged if we are making certain profit. Now if the company is in loss, we do not have to pay the tax. So over here I'm going to use the formula, if formula over here, which I've already calculated. I'll delete it and use the formula once again so that you understand it. We are putting over here the if function, so that if our profit is 0 or less than 0, we do not have this tax figure, should not get calculated. Ideally only taxes we have to pay only when we have the profits. So since this is some condition is there, we are using this if formula over here, if function over here. Now if you are earning if this is less than 0, then the tax should be 0 over here, or else you have to multiply, you have to calculate the tax. For that, the profit should be multiplied with the tax rate. And I'll make it as negative, this rate over here, so that I get negative figure over here, because these are expenses. So right now we are having the profit of 3 lakhs. 10% of 3 lakhs is 30,000, and here now we get the net income. So this is the actual condition right now. This is because the assumptions are based on the actual data. This is what is going on in the company right now. The customer base over here is 10,000 and the price per subscription is 50. This way we have calculated the net income. Now let's suppose our future projection of this net income. This is for okay, so this is some mistake over here. Fixed asset, again this should be negative. Now I forgot to make this cost as negative. All the cost we are keeping it negative. Okay, so over here this was the error. I've corrected it. Now if you see, now the net income is 90,000. Let's suppose we want in the next year or in the coming future, we want this income to boost up to 1,50,000. So for that, now we want this net income over here, this is one constant. I want this to increase to 1,50,000. Right now it is 90,000. Let's say this could be for next month or maybe next year, any projection. Now either for this, what we can do, we can change the figures manually over here. We can change the we can increase the customer base over here manually and see whether this is going to be 1,50,000 or not. Like over here this is 10,000. What if I make it as 10,500? See, it is 99,000. So this way we have to keep on doing it till we reach this 1,50,000. So this is a time consuming process. Okay, so rather than this, here we will use the function of goal seek. For that we need to have certain constraints. First constraint, we want net income in near future, we want it to be 1,50,000. So going to data over here, you'll find goal seek. Under what if analysis, we use what if analysis to see whether if we change certain constant, what will be the figure into another variable. Okay, like if we are changing the customer base over here, or maybe we are changing current price per subscription, how will the net income change? This is when we use what if analysis. When changing in one variable would affect, when changing in one constant, you can say it would affect the other constants. So here we are changing the customer base. We want to see the how much the customer base should be increased to increase the net income. So set sale over here, we will set on customer base. Then the value, we want it to be 1,50,000. So first here cancel this. Let's start it again. Set cell, we have to see the net income actually. By changing, we are changing this cell, the customer base right now. So you can see here, if we change the customer base to 13,300, then we will get the net income of 1,50,000. This way you can use what if analysis. Under what if analysis, you can use goal seek to set one to change the one variable and see the effect on the other. We have changed the variable here as customer base. We have changed this and we wanted to see the net income as 1,50,000. So we have to increase the customer base to about 13,333 so that we can have the income of 1,50,000. But like if this is not ideally possible, these are just the assumptions. If this is not possible to increase the customer base to like 13,300, for in that case, to get the net income, okay, here then we have to make certain other constant we have to keep, and then we will see how we can get the information. So customer base, let's suppose the maximum customer base over here, we can have it initially. If you remember, when I started doing this, I was having 10,000 as customer base. Okay, and my profit was 90,000. We are forecasting profit of 1,50,000. So we wanted to see the change in the customer, how much customer base should be increased. So to have the profit of 1,50,000, we have to increase our customer base to 13,333. So these are just figures, but practically if this is not possible, then we will see the customer base that we have over here as a constant. The maximum that we can have, let's assume just 13,000. Initially it was 10,000, and to have this profit, we can have the customer base of, we have to have the customer base of this much. But if this is not possible, what we have calculated on the basis of market trend and the historical data, that we can have maximum 13,000, we cannot increase it. And the other constant over here is current price per subscription. This we haven't changed. We even have the option of changing this. We can keep the customer base as 10,000, and we can increase the customer price subscription. This way also we can get the net income of 1,50,000. But with the help, when we use goal seek option, we can, it is limited to only one constant. Either we can change the customer base or we can change the current price. We do not have the option to change both of them. So when we are working with multiple constants, when we have to see the changes in multiple constants, then we can use sensitivity analysis. For that, I have made here the constant as net income. I want the net income to be increased to 1,50,000, but I cannot increase my customer base. This is the highest limit, and even the current price subscription right now over here is 50, and I'm assuming that more than $90, I will not be able to fetch the customers then. So nobody is able to pay or is ready to pay more than this. So here we can use the help of solver. If you do not have solver in your Excel, you can download it by going to files, and there you will find, here in files you will have add-ins option, and add-ins option you will get solver. So just enable it. You can, then you will see this tab over here. So we'll use solver over here. Now set objective over here. First one, our objective is this much of net income we are looking for. We have to provide the value. This is 1,50,000. Now the variable cells over here, by changing which variable cell, this is the variable cell. I want the change in both of them. I want to see the changes in both of them. Now there are certain other constants which are subject to the constant, so I will add over here. First one is this customer base is the constant over here. Now if this is greater than or equal to the other constant, that this is the cell reference. Okay, this is the customer base. Now I cannot increase to this much extent. My constant over here is only 13,000. Okay, so add it. Next constant I have is customer price per subscription. This is the cell reference of customer price. This should be either less than or equal to 90. This is the maximum I can go. So here I provided the two limits, first for the customer base and the second for the subscription. Okay, that's it. Now here I will solve it. Click on solve. Now you see the change in the customer base. I have made it 13,000. This is the maximum I can go. So if the customer base changes to 13,000 and the current price per subscription, if I change it to 50.51, then the net income I will get is 1,50,000. So this way we can use solver. So solver will actually help us here. The solver will actually help us when we have more than one constraints to be changed. Now over here, with the help of goal seek as well as with the help of solver, we are getting one price. Okay, this is the one price, one base price over here, that is 50.51, and then we have one customer base over here, which is the figure is 1. On this one figure I'll have 1,50,000. Let's suppose I want multiple data over here, multiple you can say assumptions, like if my current price is 60 and my customer base changes to, let's suppose, 13,100, then what will be the net income? To solve all these things, we will then make here a table. This is known as your price and customer base sensitivity calculation analysis we're going to do, where we will have over here on the top I have written already customer base. On here vertically we'll have price per subscription. So this is the assumptions over here. Right now I am getting this. Okay, this is we have received from this, we have calculated from with the help of solver. It is solved, or the assumptions, it is sorted out to 15.51. so this over here I'll keep it over. and we'll keep it at as 2 decimal places, or if you want we can even remove the decimal places over here. This way I have rounded up this up. Similarly here we'll have the assumptions of the customer base, which is 13,000. So we have to take a benchmark, like the difference of 5,000 or maybe 100, whatever we are expecting. Let's say that we'll take the difference of 2,000. So here we are going negative. So we are having here differences of 2,000. Okay, now we will estimate the price and customer base sensitivity over here, and here I'm increasing it with 2,000. Similarly I'll do it with the price. I can make the change of $1 or maybe $5, depending on what kind of sensitivity we are doing over here, sensitivity modeling that we are doing over here. I'll make it as 1 if there is change of $1. I'm changing the price range over here, and here also I've changed the customer base range. Now here I will increase by 1, and we'll make the net income as dynamic over here. So net income, we have the net income where over here we have the net income. This is dynamic. Okay, because we always want net income. We are projecting this figure, this profit in future. So for that, how much changes we should make? Okay, like this is in case of 1,50,000. This I will make it as I will just put another color over here, because this is what is our original assumptions. 13,000 over here, this is, and over here I have 51. Now here we can use data table. Go to your data. Here in what if you have data table, So this is your input cell over here. This would be your customer base assumption, that is okay, and your column input sale with will be your current price subscription assumptions that I'm taking. So this way you're getting the figures, the entire figures it is coming up for this basically shows in case you have 9,000 of your customer base at the price, this is the price per subscription 48, then your profit over here would be 51,000. At different range over here you can select the different range provided for the prices. You can see different price range, and here different customer base range. On the basis of this intersection over here, this will show you, like this is showing you on the basis of 11,000 customer at the price per subscription, the profit would be this, calculating and assuming all the variable cost and fixed cost. So this is all about your financial modeling and sensitivity modeling. Hope you've understood how with the help of Excel and Excel tools we can forecast figures for future, and we can forecast the net income which we are expecting, and what are the other constants which will affect the net income that we want to have in future. So this will help you in decision making and other requirements that is needed to reach to your goal. That's it for today. If you have any queries, you can write to us at www.bispsolutions.com.